So first we'll go into the pros and cons of a large fund and a small fund. So maybe you're familiar with Chris Sacca's Lowercase Capital Fund 1, arguably the greatest venture capital fund of all time, which returned around 240x of its original invested capital to its LPs. This fund started in 2009 with just $8.5 million to invest. Because Saka invested in companies like Twitter, Uber, Instagram, Docker, Twilio, Stripe, and Kickstarter, among others, he returned around $2 billion to his LPs, according to some reports. I mean, ridiculous. $8.5 million to $2 billion in what, 14 years? Insane. Best returning fund of all time. I will almost certainly write more about this fund in the future. But anyway, so that's the best returning fund from a fund multiple perspective. But what about from a total dollar perspective? After all, $2 billion is obviously a lot of money, but there are funds that have had more than $2 billion in returns. Well, look no further than A16Z. Across their first two or three funds, I'm not sure exactly how many funds, but they invested around $8 billion of capital, which is just insane, first of all. But what's even more insane than that is that as of 2021, those investments were valued at around $30 billion. And those returns came from investments in companies like Airbnb, Coinbase, Stripe, Slack, Databricks, Roblox, Pinterest, and many more unicorns and decacorns. Unicorn being $1 billion companies, decacorns being $10 billion companies, that I didn't mention here. So that's only a measly 3.75x compared to Saka's 240x. But I mean, good Lord, 30 billion dwarfs 2 billion and dwarfs probably any other venture firm ever in the 12-year stretch. So which fund do you prefer? You'd probably say the $30 billion fund because $30 billion is $30 billion, but I can assure you that A16Z is a category of its own. In fact, most large funds, most multi-billion dollar or billion dollar funds have actually underperformed even the S&P 500 in recent years. As of December 2023, large funds considered $250 million and up had an average IRR of 9.7%, while smaller funds, 250 million and lower, had an average IRR of 17.4%. Similarly, only 3% of large funds returned at least a 3x, while 22% of smaller funds returned at least a 3x. So maybe small funds outperform large funds easier from a fund multiple and IRR perspective. I mean, this makes sense because a small fund really only needs one unicorn across its 10-year fund to succeed, while a large fund could need multiple unicorns. So the first chart is based off of a $50 million fund. This chart shows an example of a $50 million fund investing $2 million into a company for 20% at the very early stages. By the time the company exits, which is at a $1 billion valuation, they estimate the small fund retains a 15% ownership in the company after some dilution. So that one unicorn that was worth $10 million when the $50 million fund invested is now worth $1 billion. So that 15% stake is worth $150 million. So again, if this is a $50 million fund, that $150 million in that one investment, that one $1 billion company, just 3x the entire fund. So assuming this fund returns no capital from its other 24 investments, that single investment, that one investment in one company and 24 other failed companies would generate a 13% IRR over a 10-year period, which would most likely outperform the S&P 500. So that's a great investment. It's much more likely that at least some of those other 24 investments return capital as well. So maybe this fund becomes a 5x. Typically, if a small fund does get a unicorn, there'll be at least a 5x fund, probably somewhere 4x to 6x. So if it is a 5x, that would make this fund closer to a 20% IRR, which is a great fund. That's a great return for any type of investing, public or private. So that's a small fund. That's a $50 million fund. So now we'll go into a larger fund. In this chart, I give the example of a $50 million fund that invests $50 million over multiple rounds into one company to attain and maintain a 20% stake in the unicorn at exit, $1 billion company. So that 20% is worth $200 million to the fund. But since it's a $500 million fund, that one investment, that one unicorn, returned only a 0.4x on the fund. So therefore, you need either 8 $1 billion companies in 10 years or find one $10 billion company, which is typically what most large funds are looking for, to achieve at least a 3x on the fund. Because again, that's the goal. That's a simple benchmark to go off of. So it may be more appealing to return multiple billions of dollars in venture capital. The $30 billion that A16Z returned certainly sounds great, but it's much harder, and only a handful, if a handful, out of thousands can actually do it. Roughly 75% of startups fail. Maybe 70%, maybe 80%, heard different numbers, but far less than 1% reach unicorn status, reach this $1 billion mark. In fact, some reports suggest that only 0.006% of startups reach unicorn status. That's one in about 17,000 companies. So it's not easy, to say the least. And this isn't even considering decacorns, the $10 billion companies, which large funds like this $500 million fund we talked about essentially need to get that 3x. Considering there are only about 4% of unicorns that become decacorns, if a unicorn is a 1 in 17,000% chance, then a decacorn is a 1 in a 425,000 chance. These numbers are obviously absurd, and I'm not sure how to make sense of them other than to say it's really hard to invest in exceptional companies. Now, maybe a lot of these companies in this report wouldn't be targeted by VCs, so maybe a unicorn is more like a 1 in 5,000 chance because it's a tech company, high growth tech company. Maybe decacorn's a 1 in 100,000 chance. Who knows? Regardless, it's very hard. So there's no right answer in which fund to go with, the small fund or the large fund. If you have unique access to the best companies and the best founders at any stage, late stage or early stage, you can succeed. One caveat is some reports show that about 60% of pre-seed startups, aka before they raise their first capital, fail, as in return $0 to investors. On the other side, only 1% of companies that make it to the Series C stage, these late stage $50 million investment stages, fail, as in return $0 to investors. So it's definitely a lot easier to return at least some capital as a later stage fund than an early stage, micro emerging fund. So I don't have too many numbers to support this, but based on various reports I've read, most large funds can return a steady, 1.5 to 2.5x on their invested capital, which is, not a great multiple in a 10-year lifespan for a venture fund, but a $2 billion fund returning $5 billion to their investors is a fantastic outcome for most multi-billion dollar, university endowments and large nonprofits that don't have access to smaller funds, since a $50 billion endowment, for example, can't really write a $5 million check into a micro fund. That won't even move the needle for them. Even if that fund returns a 10x, they get $50 million back. That doesn't do anything in a $50 billion fund. But an endowment can put a $200 million check into a $2 billion fund, and they'd be happy to get $500 million from that. That moves the needle. So the market for these large funds is the massive endowments and the massive nonprofits, which need a more steady and safer return that can return real absolute dollar values to their massive fund. High multiple returns, as in 4x, 5x, 6x on the fund, are less important than absolute dollar returns. So as long as you're at least beating the S&P 500, you're in a good spot as a large fund. But a lot of people argue that venture capital funds, since they have a lockup period, you can't access your capital for 10 years or 11 years, 12 years. It's not enough to just beat the S&P 500 because that's a liquid capital. There has to be some penalty for that. You kind of have to beat it by 3% or 4% or 5% to make up for that lockup period. So as we talked about earlier, the smaller fund certainly has a better chance of returning 5x, but since most startups fail at the stage these investors are investing in, at the very early stage, there's a much higher chance of them returning less than a 1x on the fund than a later stage investor. So maybe you invest in a venture capital fund that returns a 5x and does great, but don't be surprised to see a different VC fund with the same amount, two $50 million funds. One will return a 5x. Another could easily return a 0.5x at that stage, since it's the highest risk stage to invest in. Regardless of the preference for a large fund or a small fund, it's a risk and reward trade-off that favors the best VCs who can source, pick, and win the best companies at whatever stage they operate in. At the end of the day, that's really all that matters, depending on the size of your fund.